Hello, everyone! Welcome back to our channel. Today, we're diving deep into a fascinating topic that affects every business, from tech startups to manufacturing giants, capital structure and its impact on firm performance across different industries. So, grab a seat and let's unpack this complex and intriguing subject together. Understanding capital structure. Capital structure refers to the way a firm finances its overall operations and growth by using different sources of funds. It primarily consists of a mix of debt and equity. Debt includes loans and bonds, while equity consists of common and preferred stock. The balance between these two sources of financing can significantly affect a company's financial health and operational strategy. Importance of capital structure. But why is capital structure so crucial? Well, a firm's capital structure affects its long-term viability, cost of capital, and even its risk profile. A well-optimized capital structure can minimize the cost of capital, thereby maximizing the value of the firm. It determines how much money a company needs to borrow or raise and influences everything from expansion plans to dividend policies. Industry variations. The impact of capital structure varies across different industries due to distinct operational and financial characteristics. For instance, technology companies often have different capital structure needs compared to manufacturing or retail firms. Understanding these nuances helps businesses align their financial strategies with industry standards and maximize performance. Capital structure in the technology industry. Equity financing in tech startups. In the tech sector, we often see a higher reliance on equity financing, particularly during the startup phase. Venture capitalists are eager to invest in innovative ideas but expect high growth rates in return. Companies like Facebook, Google, and Twitter have historically relied on strong equity bases, which has allowed them to scale rapidly without the burden of heavy debt. This approach offers several advantages. Scalability. With substantial equity, tech firms can focus on growth and innovation without worrying about immediate debt repayments. Flexibility. Less debt means lower fixed costs and more flexibility to pivot or adjust business models. However, there are also challenges. Shareholder influence. More equity financing means shareholders have a significant say in company direction, which can impact management decisions. Dilution of ownership. Issuing more equity can dilute existing shareholders' ownership percentages, potentially leading to conflicts of interest. Case studies. Consider companies like Amazon and Tesla, which have used equity to fuel aggressive growth strategies. Their ability to innovate and expand rapidly has been closely linked to how they structured their capital, prioritizing equity over debt during crucial growth phases. Shifting gears to the manufacturing industry, companies tend to favor debt financing, especially for capital-intensive operations. Manufacturing firms require significant investments in large machinery, equipment, and infrastructure, making debt an attractive option. Leverage for growth. Firms can use leverage to fund growth initiatives, benefiting from interest tax shields that reduce taxable income. Preservation of ownership. Debt financing does not dilute ownership, allowing original owners to retain control over the company. However, high debt levels also pose risks. Economic downturns. In times of economic downturn, high debt can be a significant burden if revenues decline. Interest obligations. Consistent interest payments require strong operational performance to service debts effectively. Successful examples. Companies like General Electric and Ford have utilized debt financing to expand operations and invest in new technologies. Their capital structures are carefully balanced to manage debt while maintaining operational efficiency and competitiveness. Flexibility in retail financing. Now, let's talk about retail. This industry has the unique advantage of flexibility with its capital structure. Retailers, especially e-commerce giants, often operate with lower debt levels compared to traditional brick-and-mortar stores. Strategic approaches. Successful retailers balance between equity and debt, allowing them to adapt to changing consumer preferences without over-leveraging. Key strategies include liquidity management, maintaining liquidity to cope with market volatility and changing consumer demands. Debt reduction. E-commerce companies, like Amazon, often prioritize liquidity and lower debt to remain agile and responsive to market trends. Industry insights. For instance, companies like Walmart and Target leverage a mix of equity and debt to maintain competitiveness while investing in supply chain improvements and technology enhancements. So, what does all this mean for firm performance? Studies have shown that optimal capital structure varies significantly from one industry to another. Companies that align their capital structures closely with industry standards tend to achieve better financial performance. Here's how it plays out. Technology firms. By investing heavily in R&D through equity, tech firms can outperform in growth metrics. Manufacturing firms. Leveraging debt for stable operations can lead to consistent returns and improved profitability. Retail firms. Balancing debt and equity helps retailers maintain agility and respond to consumer trends effectively. Strategic decision-making. Ultimately, understanding the impact of capital structure is not just about numbers, it's about strategic decision-making that aligns with market realities. Finding that sweet spot between debt and equity is crucial for durability and growth. Firms with optimal capital structures often exhibit improved profitability. Lower cost of capital leads to higher profitability and better margins. Reduced risk. Balanced capital structures help mitigate financial risks and ensure sustainability during economic downturns. Enhanced valuation. Firms with sound capital structures often enjoy higher valuations due to investor confidence. In conclusion, the capital structure is a vital aspect of a company's financial strategy that significantly impacts its performance and competitive edge. By understanding the nuances of capital structure across different industries, businesses can make informed decisions that support growth, stability, and shareholder value. So, what do you think? How does your industry approach capital structure, and what insights can you share? Comment below with your thoughts. If you found this video helpful, don't forget to like, subscribe, and hit the bell notification for more engaging content. Thank you for watching, and remember, in the world of finance, knowledge is power. Until next time.